Hello, friends, and welcome to the Tuesday Night Stock Club. Yes, you are in the right place, but more on that in just a minute. I'm Doug Gerlach, President of iClubcentral. Welcome to our webinar for Tuesday, February 2nd, 2021. Happy Groundhog Day. We're going to be taking a look at the market year to date and what's going on. We're going to have time for your questions. We'll be taking a look at a couple of stocks of interest and using Toolkit 6 to compare them. And we'll have plenty of time for your questions. As always, the PDF handout is available in the Handouts tab of the presentation. But first, let's talk about our new webinar series. As I mentioned last month in January, we are phasing out Toolkit 6. We finally, it's been a long run, and we are finally starting to phase out support for the program, and the official term for that is sunsetting the software program. We haven't officially decided on any date or time frame. We do know that we're not supporting any new updates or adding any new features to the Toolkit 6 program, and we're going to continue to support Toolkit 6 for the foreseeable future. Our practice usually in the past, when we have stopped supporting a program, we've actually continued to support it as long as we possibly can, but it's getting increasingly difficult with all of the internet security programs that users are using to support a legacy application like Toolkit 6. And so in many cases, there's just nothing that we can do for users who are having problems with the software. But as a result of that, and kind of in advance of it, I decided it was time to discontinue our monthly Toolkit 6 user group webinar, but I did want to continue reaching out to our users of all of our tools. We also suspended the Lunchtime Stock Club webinar at the beginning of the year. That was my monthly opportunity to talk about market conditions and other topics related to the market and to our products. And so I decided, well, let's combine the Toolkit 6 user group and the Lunchtime Stock Club, and we'll use this Tuesday, this first Tuesday of the month's time slot for what I'm decided to call the Tuesday Night Stock Club. And so that's where you are. You've been automatically registered for it. We're just carrying over, renaming the Toolkit 6 user group. I expect to cover market commentary and stock discussions, the same as I did in my Lunchtime Stock Club. We'll continue to demonstrate Toolkit 6 and answer questions about the program, but also we'll have the opportunity to present some of the other iClubcentral tools and how you might integrate those into Toolkit 6 and to your investment portfolio management. Perhaps we'll have some guest presenters. We'll also be featuring content from the Investor Advisory Service and the SmallCap Informer newsletters. And as always, provide an opportunity for you to ask questions about all the iClubcentral tools and other topics related to the market. And so that is the intention of our new webinar series. To continue participating, you don't have to do anything if you are registered for the Toolkit 6 user group. If you wish to unregister, there is a link at the bottom of the webinar reminder emails that allows you to take yourself off the registration list. But the archived and new webinars will be available for viewing on demand at our YouTube channel, so you can find that and bookmark that. And please let me know if you will continue with any questions that you might have at my email address, gerlach@iclub.com. We are continuing to offer the data for the Toolkit program, so that's not changing. There's no official, as I said, there's no official announcement. We're just kind of setting the stage. At some point, we're going to be making a decision. We're looking at all of the products in the iClubcentral toolset and figuring out what to do and how to position them. We've had a lot of success with our SmallCap Informer newsletter, and it's turned in a really terrific track record so far. And our Investor Advisory Service newsletter continues to perform well and be on the Holbert Honor Roll for 11 straight years. And we were featured and mentioned in Barron's last week, which was very exciting. So those newsletters are taking an even more important position in our product lineup and reaching sort of a national level of exposure. So we want to be able to support that as best we can. And so the Toolkit program, as there is a valid option available for people who might be aging out of the Toolkit 6 program or who are unable to use it on a new computer, for instance, in the Better Investing online tool set, which is increasingly adding Toolkit 6 features. So there's a whole lot that you can do there, and there's some additional benefits as well. But so as I said, this is kind of a preliminary precursor, but it was time to consolidate a little bit with my webinar schedule. Feeding into it, of course, was 2020 and now what I'm seeing for 2021 with an increased online presentation schedule with chapter events for Better Investing, for the American Association of Individual Investors, for the Money Show, where I am doing multiple webinars per month for various organizations across the country. And so that's just also consuming a lot of my bandwidth. So streamlining our webinar series seemed to be a prudent step to take. We'll continue with our Investment Club webinars on the third Tuesday of the month, and those focus on not only club accounting tasks and treasurer tasks, but also running an investment club operations, and occasionally we look at portfolio management tasks for a club and how they might differ from what an individual investor might do with his or her personal portfolio. So we cover the gamut of topics in that Investment Club webinar, and we will of course be continuing with that. So that's what's going on with our Toolkit 6 user group webinars. So welcome, glad that you could be with us tonight. And let's take a look now at the state of the stock market here at the beginning of February. Here is a graph of the market performance year to date for the three segments of the market that I like to follow, that I think represent what's going on in markets around the world and in the US. The big news is that small cap stocks are on a run. Year to date, the S&P Small Cap 600 index is up 8.4%. The Russell 2000 index is also up. The EFA index is the Europe, Australasia, Far East index, which had been doing fairly well, but has slipped a little in the last couple of weeks. Now up just 1.4% for the year. And then the S&P 500 index up 1.9% year to date. Started out rather strong and through January was performing well. Had a little bit of a retrenchment as we ended the last week of January. A lot of the volatility relating to GameStop and the short squeeze in the market, but we'll talk about that as well in just a minute. But this is one of the reasons I like to look at these three segments is that there's traditionally been a lot of non-correlation between small caps and large caps and international stocks versus US stocks. And when you look at these three segments, it's not at all uncommon for one of them to be performing really well, one of them to not be performing as well, and another one somewhere in between. But you can see how they perform at different times during economic cycles, domestically and globally. They've all started to track a little more closely together in the last decade, simply because of the globalization of markets and economies. What impacts the economy in the US may also have a ripple effect around the world and vice versa. And the same thing with markets, as investors have now more access to markets all over the world, whereas 20 years ago, it would be very difficult to trade stocks in a foreign stock exchange outside the US. But I still think it's useful. And I love to see those small caps outperforming. They've had a couple of slow years. We've been in a long macro trend of large caps outperforming small caps. Fortunately, our small cap picks in our SmallCap Informer newsletter have been outperforming the S&P Small Cap 600 index in every time period. And so that's really great to see that we're pulling out the best small company stocks, and we're at least outperforming the index, even if we're not outperforming the S&P 500. And that's not our objective. But over time, we would expect to see some greater outperformance from the S&P Small Cap 600 Russell 2000 index. And I've talked about this in the past. I believe that the S&P Small Cap 600 index is a better representation of small cap stocks as compared to the Russell 2000 index. And so that's why I use that as my benchmark for small company stock performance, which I think is a better representation of small companies, and especially small companies that are of sufficient quality to warrant our consideration. It's closer to the stocks that you would study using the stock selection guide. The Russell 2000 is just 2,000 companies. The S&P Small Cap 600 is 600 small companies that have been selected because of their attributes. And so it's a little bit higher target to reach in many cases. The S&P 500 PE ratio is still climbing. It's up from where it was and in December. I look at this on a monthly basis. This tells me a couple of things. You can see the red dotted line shows you where the S&P 500's current PE ratio is relative to history. So you can see that prior to the 1990s, if the PE of the market was 40, that would have been an incredibly odd, unusual, perhaps terrifying event. Following the bull market of the 90s, where we saw PE ratios reaching into the 40s and then declining, we see the anomaly of the 2008 bear market there, where PE ratios skyrocketed into the 60 level and then fell back down. And now those PE ratios are high. There are two things going on. One is this long-term secular bull market that we've been in now since 2007. And yes, I know we had a bear market in 2020, but it was super short, and we're at higher levels now than we were before then. So it's almost as if it was just a temporary blip in the long-term growth trajectory of the S&P 500. So that's one. Interest is high in stocks. Interest is low in keeping your money in the bank, in a money market or a savings account, because you're just not getting any interest. Interest is low in putting your assets into the bond market. Again, the perception is that there's very low yield and prices are not attractive. So investors have cash and they're putting it in the stock market. That's keeping valuations up. Of course, right now, we're also seeing the impact of a down year for a lot of companies because of the pandemic. So we've had a couple of quarters of slowed GDP growth. We've seen companies posting negative earnings. We see a lot of companies that are hunkering down in survival mode. And that's balanced by companies like Amazon and Apple and Google, which are performing like gangbusters. Amazon announced earnings today, and they were twice what analysts expected. I mean, it's just phenomenal how well that company has performed, and it's understandable. We all understand it. But that's one reason the PE ratio is 38, almost 39 on an estimated basis. When we look at the S&P 500 earnings, again, you can see this trajectory upwards, moving up and to the right, the propensity of companies to deliver increased profits. When they're in the S&P 500, you see the 2008, 2009 drop-off during the last recession and the bear market. And then you also see the impact of 2020. Earnings were strong coming into 2020, and they've fallen off since then. And again, so earnings are down a little bit. Interest in the market remains high, and so that just means the valuations, all in all, are pretty elevated. And that for those of us who like to invest in growth at a reasonable price, we can find the growth. It's not always easy to find the reasonable price, but these trends have been in place for some time, and I don't see them letting up anytime soon. I mentioned a little earlier some of the volatility in the market related to GameStop and everything that was going on, and I did want to address it very briefly. In short, what happened is there was a short squeeze on GameStop. There were some hedge funds, some big hedge funds that had been buying short GameStop, not GameStop, GameStop, has been losing money for a couple of years. We'll look at that as well. So it's really not a very interesting company. They think that they might get back to profitability as they restructure. They're the traditionally mall-based retailer of video games and computer games, and especially during a pandemic, but even before then, it was becoming increasingly common for video game users to simply download the game. You didn't need to buy it anymore. You could just buy it, download it. You didn't need to buy a CD anymore. You didn't need to buy a DVD. You didn't need to go to the store to get the release. You could get it right away on the day it was released and download it to your game console. So stores like GameStop were struggling in that environment. So some hedge funds were figuring that at $14 to $17, it was overvalued and likely to go down even further, and started to short the stock. In other words, buying shares and then selling them, and then promising to pay back the shares at a later date. Hopefully the shares would be cheaper at a later date, and then they would be making money. There were a message board on the Reddit internet website that noticed that there was a lot of short interest in GameStop stock, and in fact, it appeared that more shares were being shorted than were actually available in the marketplace. By some estimates, 120% of the available stock shares of GameStop were being shorted. So these individuals realized that if you bought GameStop and enough people bought shares of the stock, the price would go up, and that would force the shorts to cover their positions by buying shares, because you're not allowed to simply short the stocks. You've got to have some collateral. You've got to have some skin in the game, so to speak. And so but of course, as the shorts were buying stock to cover their short positions, the price of the stocks were going up. And so that makes it even more expensive, and they're losing more and more money. And so as more and more people were buying the shares of the stock based on the advice from this message board, the price of GameStop this year has gone from 17 to it peaked at $428. So some investors who are buying at 20, 30, 40, 50, $100 a share, we're seeing pretty incredible gains, at least on paper, and the shorts, by some measures, the leading hedge fund that was shorting this stock lost 50% of its value. So we're talking about billions of dollars in January because of this, 1,700% price gain. And this, as this strategy was working, they started paying attention to some other heavily shorted stocks, including AMC, the operator of the movie theater business, which is understandably under pressure because they're all closed. BlackBerry, which again, no one even really remembered was still a stock anymore after the BlackBerry phase of 15 years ago. Nokia, again, not as popular a company as it once was, heavily shorted. So as the investors started targeting those stocks, buying shares, the shorts had to cover those as well. So the hedge funds that were involved were running out of cash because they were trying to cover their short. They could have closed out their short positions, but there apparently was some stubbornness to do that, and so they continued to let the losses run instead of closing it out. But the problem that this brought for brokerage firms like Robinhood was one of the prime contenders. Robinhood is a very small brokerage firm relative to others in the industry. And when customers are buying and selling stocks with at high levels, and when they're buying options and they're shorting stock and they're going long, GameStop needs, or Robinhood rather, needs to have capital to make sure that they can settle all of those trades, and there are rules in place that brokerage firms have to live by in order to make sure that if customers want to sell and take the cash, sell their assets and take the cash, that the brokerage firm has those assets available, has the cash available. So Robinhood ran into a crunch as well. And had to bring in additional capital. So it became a very, very frothy market at the end of last week. And a lot of institutional investors and individual investors all started pointing fingers at each other. Here's the graph of year-to-date of GameStop's, the GME's stock price, and you can see peaking there. It actually reached as high as 428 intraday. Today, it closed down 60% to $90, and that was a $135 loss for the day. So again, a lot of people trying to exit their positions now and finding out that nope, they're not getting $400 a share or $300 or $250 a share. And a lot of naive investors were thinking, oh, I could at $250, it was $428, so I could buy it at $250 and just hold on to it for a couple of weeks, and it'll be bounce back up. So a lot of volatility in the market, a lot of naive investors, a lot of sophisticated investors, all kind of coming together and creating this maelstrom of a disaster. When you look at the fundamentals of GameStop, here it is since 2018. They haven't made money. The last time they made money was 2017. So they're into their third year on a trailing 12-month basis, or they're down $5.31 in the hole. So, but still $6.4 billion in revenue. So, you know, it might be conceivable that they could turn the company around. From our perspective, this just looks like a disaster. This is not a company that we would be taking a look at. Simply, one, it's not making money. Two, it hasn't made money for a couple of years. Three, the prospects of it making money are uncertain. Four, revenues have been slowing. So you kind of add it all up and say, yep, this is not really a company that we're interested in from a fundamental perspective. So, of course, we're going to be hearing a lot about cleaning up the whole mess. Of course, regulators and the media and politicians even getting into the act, all chiming in with opinions. There may be investigations and lawsuits. Although from what I understand, it might be hard to bring a case against the message board participants for market manipulation because it was all out in the open. There was no concerted secret effort. They just identified from publicly available information. Here is the short interest for GameStop. Here is the hedge fund that has released this information about their holdings and their positions. Put two and two together, it won't take much for much buying to see the price go up. And I think it outperformed anyone's expectations, of course, but it did generate a whole lot of interest. And the story of the average American investor versus big Wall Street, that just is a great storyline for headlines, and people are lining up on each side of that issue. And I mentioned Robinhood because as they were faced with liquidity crunches and realizing they might not be able to keep the business going, given all of these small odd lot transactions that were going on at increased levels, did start restrict trading. So you could only buy one share, for instance, and that just annoyed a whole lot of people. But again, it's just part of the regulations that are meant to protect investors. And Robinhood's founder is scheduled to testify before Congress later this month in February. So we'll hear what they have to say at that point. There is the conspiracy theorists will also point to the fact that one of the key funders of Robinhood also is engaged in involved with the hedge fund that was shorting the shares of stock. And so there are different arms of a business that is somewhat connected. So people will say, well, that's why Robinhood was trying to protect the hedge fund. All the brokers are gathering wagons to protect their industry. And so they're fighting off this, what is perceived as an assault for individual investors. Again, so much drama going on. but the bottom line is that a lot of people are going to be losing money. Some people, the lucky few, are going to be making money, and hopefully a lot will lose their lessons. There's also a question, why are these professional money managers not hedging their positions if they're taking these naked short positions? What are they doing to protect themselves? Are they so arrogant to believe that they're absolutely right? And that, again, that's fine. But if you're playing with other people's money, you do have a responsibility there. So if their customers were not aware of these highly risky transactions that were going on, that puts them at liability as well. So it's such an interwoven story, all sorts of aspects to it, made for fascinating news copy in the last few days. Hopefully it's going to settle down, simmer down, and we can get back to business as usual, which is finding good stocks at good prices. In the long term, fundamentals do drive capital appreciation. That's what we believe in as long-term focused fundamental investors. But in the short term, all sorts of irrational and unpredictable factors will drive prices. And this is why it's so hard to try to time the market or time your entry into and out of a stock because of the impact the unpredictable events have in the near term. Over the long term, they become water under the bridge, but in the near term, it can make all the difference when you're trying to scrape together pennies or dollars per trade in order to eke out a profit. For us, as long-term investors, focusing on good stocks at great prices is going to continue to be our approach. You can read more on the SmallCap Informer website in my blog post, which was also part of our commentary for the February issue, where I go into a little bit more detail, but I pretty much summarized what are the key takeaways for me from the GameStop fiasco. Also interesting today, February 2nd, breaking news, Jeff Bezos has announced as he's stepping down as the CEO of Amazon, effective in the third quarter of this year. His replacement will be Andy Jassy, who is someone who's been with Amazon for almost 24 years. He's the head of Amazon Web Services, known as AWS. That is their cloud-based server farm operation, which supports all sorts of individual and professional websites and web services, and it's really one of the key players in the whole cloud computing segment. Bezos is going to become the executive chairperson. He's going to remain engaged, and remember, he's still a significant shareholder. But the question is, one reason to sell that Better Investing often teaches is that you should consider selling a stock when there's an adverse change in management. And so that brings to the table, should we be thinking about Amazon as a sell if you currently hold it because of this change in leadership? Jeff Bezos founded Amazon. It was started as a very small business. The early tales of how they started selling books and set up a little alarm on a computer, a bell that would ring every time an order came in the first couple of days. They'd get 3 or 4 alarms a day, and everyone would cheer. And then within a couple of weeks, they had to turn it off because it was so annoying. It was ringing all the time, to grow to be this enormous e-commerce business that a lot of people were relying on in 2020 for delivery of everything from groceries to essential goods and services. So let's think about how his departure will impact the Amazon stock. When you look at what Jassy has been doing for a very long time with the Amazon Web Services part of the business, in the fourth quarter, the revenues for that division alone grew 28%. So he's been building a business that supports not only Amazon's web-facing web business, right? They are an e-commerce business, so that's important, but also for many other companies. Amazon has recently changed CFOs, and it's probably not anything that, even if you were a shareholder, you paid any attention to. It was pretty seamless, and so that seems to indicate there's plenty of potential for leadership within Amazon. And as I mentioned, Bezos is still a significant shareholder, so he's likely going to remain involved and remain a big influence on the company. The company's revenues and earnings as of the fourth quarter that was also announced today at record levels. So I don't think, in my view, this is a negative change. This is not an adverse change of management. Pundits who look and follow Amazon note that they have a lot of high-level talent in the management suite, that they've recruited people from different businesses, both in Silicon Valley and in the world of commerce, to come together and build their company. So I think that they're going to be fine doing what they do. Jeff Bezos may be happy not to have to deal with any coming onslaughts of antitrust cases or other sorts of congressional inquiries. He does own the Washington Post, so I think he's going to be happy to spend some more time there and not have to worry about the impact on Amazon of what the Washington Post might be doing. So big change, but on the other hand, Amazon's position right now seems to be very strong, and I would suggest that it's not a key consideration. Amazon has never really fit our better investing model, the SSG model, because they've had such a strong focus on building the business and not worrying so much about profitability. And they keep saying, yeah, we'll get to that. I think in the last couple of years, they've started to focus a little bit more on posting, showing that they are managing to the bottom line a little bit better as they've gotten to be as big as they are. But I know that it is a company that many investors are interested in. So I also wanted to mention our SmallCap Informer special report for those of you who may or may not be subscribers. If you are a subscriber, hopefully you've already downloaded your copy of our top small cap stocks for 2021 special report, in which we identify the top 10 best companies for total return that we see now for the 2021 year. If you are a subscriber, you can get it in the subscriber section of the SmallCap Informer website. If you're not a subscriber and you wanted to try out our SmallCap Informer newsletter, you can visit the smallcapinformer.com website. Check out our track record where we show you the recent performance over the last 1, 3, 5 years. We're into our 9th year, so pretty soon we'll have a decade's worth of track record for you to analyze. But we've been outperforming that S&P Small Cap 600 index. There's a promo code Tuesday that you can use to save on a subscription to the online edition. If you subscribe, you can get instant access, and you'll get that our special report for 2021. Also, our 2021 Outlook webinar, subscribers webinar, is also still available for subscribers only on the website. We'll be releasing that in the next couple of weeks on our YouTube channel, so you will be able to view it there. But that would be an additional benefit of subscribing now for the to receive the special report and the webinar that's still embargoed for subscribers, and a year of the market-beating SmallCap Informer stock newsletter, focusing on small to small mid-cap stocks. And we represent 2 companies each month with recommendations and complete write-ups. So let's take a look at a feature of Toolkit 6 and talk about a couple of stocks that we actually cover in the SmallCap Informer website. I'm very optimistic about the residential construction, the residential home building industry, even as we go into 2021. Residential construction industry is part of the consumer cyclical sector in that when the economy tends to slow down, when we are in a recession, residential construction companies tend to see home sales drop off and see their performance inhibited. But this has been a very strange recession that we're in with the pandemic. So I still see a lot of growth ahead for the two residential home builders that we cover, Century Communities and LGI Homes. Both are fast-growing, high-quality businesses. Both have performed very well for our subscribers, and the outlook for 2021, I think, for this sector is still pretty strong. When you look at the the percentage of home ownership in the U.S., we're still not back to where we were prior to 2007. So that's pretty phenomenal, but it has been growing. And the trends in the second, third, and fourth quarter of 2020 rather, with interest rates so very low, and interest rates being cut, and a lot of demographic trends such as millennials getting to be the age where they're settling down, where they are getting married, where they're thinking about having families, and along with that, they're thinking about, let's move out of the city into a house. And the pandemic and lockdown orders and work from home trends accelerated that drive for many people. If you're going to be working from home, let's work from a nice home instead of an apartment where we're all crammed in, where there's not enough space, where we've got roommates, or where your spouse is also working, and so one of you has to work in the bedroom. So a lot of those trends, put them all together, and entry-level homes had a terrific year in 2020, and I think that trend is going to continue through 2021. And so these are the two stocks that we cover, and we recently highlighted LGI Homes, but I thought it would be interesting to take a look at the comparison guide of Toolkit 6 and look at our stock studies for both of these companies. Here is LGI Homes. You can see a great trajectory of sales and profits and earnings, and analysts are optimistic for the next couple of years. So they continue to perform well. My estimated growth rate of sales and earnings for LGI Homes is 11%. I think that's a little conservative, but I'm allowing for a pretty strong performance in 2021, and then maybe seeing growth slow a little bit going forward and averaging around that 11% rate over the next few years. $1.8 billion in revenues last year. And this is Century Communities, and yeah, you might not have even noticed that I changed the slides. They have a very similar growth trajectory. Century Communities is a little bit bigger at $2.5 billion last year. But again, outlook is strong. Analysts are optimistic. My growth rate for Century Communities is 12%. So pretty close. We're talking both in the same range, to be sure. I'll just go back to LGI Homes, which is there, just so you can see just how similar these two companies are in terms of their growth trajectory. Century Communities is one of the top 10 home builders in the US, so even though they're only a $2.5 billion company, this is actually one of the 10 biggest publicly traded home builders. LGI Homes is further down on the list. They have issued their objective of being a top 5 home builder. Both of them have made occasional acquisitions. So Century Communities has kind of leapfrogged ahead on the basis of a 2019 acquisition that they made that expanded their geographic footprint. Both of these companies are very smart. They don't just operate in particular in a certain isolated area of the country. They're broad-based in areas where there is high housing demand, whether that might be North Carolina or Georgia or Florida or Washington State or the Bay Area of California or Las Vegas. They're looking at areas where the demographic trends are driving these types of communities. They both focus on building homes to just a few different floor plans, so they're not customizing everything, which drives up costs. Their communities are very well thought out, and the homes will have options for, or include options for high-speed internet and solar energy, for instance, built into it. So highly attractive communities, and starting home prices in the $280,000 to $300,000 range. So that's what's considered entry level today. We also, interestingly, we also cover Cavco Industries, which is a manufacturer of manufactured homes, a maker of so they build mobile homes and manufactured homes, and again, that business has been doing very well. More constrained than LGI Homes and Century Communities on the production side. 2020 created a huge demand for home building materials, and so we expect to see some margin deterioration by both Century Communities and LGI Homes for 2020 because the price of lumber has gone up so much because there's so much demand for it. For Cavco, that really hit them hard, so they had to slow down production. They simply couldn't get the materials they needed. So their backlog is just enormous at really high levels. So once they are able to start ramping back up and get their facilities going, I expect good things for them as well, but left them out of this comparison. So let me flip over to Toolkit now, and I'll open up LGI Homes first. So here you can see the front. On the back, I have left, you can see this is considered a downtrend of margins, but that's pretty nominal. And as I said, we expect a little bit more of a downtrend for 2020 because of the impact of the pandemic. But I didn't strike out any outliers, so the average PE ratio is 13.8 to 5.7. Use those, use the trailing 12-month earnings per share to determine my forecast low price. No, I used the 80% option. Excuse me. 80% option there to account for a 20% decline in the price. So now let's go ahead and we'll open up Century Communities. So again, very similar growth footprint, slightly higher growth rate. Trend has been coming down a little bit for Century Communities. The margins are much lower, which is interesting. Debt is a little bit higher as well, as they've taken a different strategy about locking in land, and they've been debt to equity has been coming down for Century Communities as they have been slowing the purchasing of land and instead buying options to purchase at a later date, which helps them manage their debt to equity a little bit. So again, P ratios 11.8 to 6.6, so very close to where LGI Homes were. So we'll use the same 80% decline option there for the price. So also in the buy zone, and the upside downside ratio also very similar. So from here, I'm going to open we're going to compare the companies. So select file, compare stocks. We will add both of these to our list, and then click the compare button and go into the compare module. So let me circle none, and we'll just talk through this as we go. Let me grab my pen, and we'll make it a nice color. So the historical rate of sales growth, again, this is probably why I'm going to make the case for not depending on Toolkit 6 to circle the winner, because in this case, the historical percentage of sales growth is 60.9 for one and 60% for the other. To say that Century Communities is the winner, they're both winners in this particular case. So I would not say that either one of those is a winner. And the same thing with the projected growth rates. At 12% versus 11%, it's so small. Is that really going to make a difference and make one be a better candidate than the other? I think that's pretty comparable. Earnings growth, LGI Homes is definitely faster at 45.6% compared to 35.4% for the historical period. So I would say that's pretty significant, and that would make them a winner in this case. On the profit margin, LGI Homes definitely has a higher profit margin. Both are seeing their margins contract a little bit, but they are definitely the better, have the higher margin. This is actually one of the highest profit margins in the residential construction construction for the entire industry. For the return on equity, I don't tend to look at it as much for small company stocks, but you know, LGI Homes is 28.8% now, but it's trending down. Century Communities is 12.1%, but it's trending up. The 28.8 is probably still pretty still a winner, I think, in my mind. And then finally, the percentage of owned by management. Again, we don't circle that in any case, but it just tells you that those are big, healthy percentages. 3.3, 4.3%. Those are pretty good percentages and pretty healthy for a small company stock. So let me flip down, we'll scroll down to the price comparisons for the next section. Let me just see if I can position this a little better. All right, so the first item here is the current price divided by the total earnings for the next 5 years. And so if the rationale here, this is almost like a long-term PE ratio element here, and the lower the better, according to Toolkit's approach. So the 1.3 ratio is more attractively priced than 1.6. So Century Communities works for that. The price range over the last 5 years, again, I don't consider that as relevant, and it's not something that is selected in the program, and neither is the current price, 47 versus 109, and that makes no difference whatsoever. The PE ratios, I also tend, in many cases, to not use them for comparison purposes on the comparison guide to select a winner, because you've got different companies perhaps at different growth rates in different industries, or different sub-industries, for instance. In this case, I think it does tell us a little bit. As you go through them, you realize how much both of these the high PE ratios are very similar. The low PE ratios are very similar. All of the PE ratios tend to be very, very similar for each company. So again, it tells us that one, both companies are performing as the market expects, and also that we can expect that kind of range to continue as long as the performance continues in the future. So I don't think that any one of them is any particularly more attractive than others. For most cases, I tend to not look at any of those. The current PE ratio, Century Communities, is at a 9.4 PE, while LGI Homes is at a PE of 11. So 9.4 times earnings, trailing earnings, is a lot less expensive than 11 times. So that would win for me in that case. The price zones, again, are for information purposes. We don't have to worry about them from the perspective of a comparison. I'll scroll down. The current price zone, they're both in the buy zone. The reward to risk ratio, again, 6 compared to 5.6 to 1. Those are very close, so I wouldn't say that either one is a winner. There's neither of them pay yield, and the total return is 17.1 to 16.1% on the annualized basis, 17 for Century Communities, 16 for LGI Homes. So again, Century Communities edges out ever so slightly. Number of shares outstanding, we don't have to worry about. Dilution, we don't have to worry about. It's pretty identical. Interestingly, if you, again, this is a case, another example of why we don't blindly accept the computer. If we say select the winner, even though they're both 0.01, the amount of dilution, LGI Homes is slightly less because these are rounded values. So again, but I think at that level, there's not really any dilution that we have to worry about. The percent payout, we don't have to worry about the relative value. Century Communities is slightly cheaper at 102.2%. That means its PE ratio is very close to its average PE ratio, while LGI Homes is 112% of its average PE ratio. The debt to capital ratio, Century Communities is slightly higher at 53%, while LGI Homes is 45%. So when you go through it, if we say circle all, here we have Century Communities being selected as the winner. If we move our mouse over, we can turn off those values that we think are too close to call a winner for. You can see that Toolkit calls the return on equity uptrend more desirable than a 28.8% downtrend. I would disagree with that, so I'm going to take off that. Both of them are in a downtrend, so Toolkit won't even calculate a winner there, but I would say LGI Homes definitely wins. I would take up all of the PE ratios because I don't think they're very useful. I'll leave the current PE ratio on. The reward to risk ratio, again, very close, maybe does a winner, maybe not a winner for a total return as well, because they're so close. Definitely not potential dilution. We don't have to worry about the payout ratio. Relative value certainly wins. Debt to capital, it's close, again, pretty marginal. So kind of depending on your perspective, they both turn out to be very close to a buy. If you are really focused on some of the quality elements, you might put a little more weight on the lower debt and higher margin business, which would tilt it towards LGI Homes. I think it's a great example of how companies can use debt to leverage their growth and grow faster. So Century Communities perhaps might be able to grow a little bit faster, but has a little more debt. But with interest rates so low, maybe that's not such a concern. And when you look at their credit ratings from Moody's and Fitch and S&P, they're both rated very highly. LGI Homes just had their credit rating affirmed by Moody's and gave them a stable outlook last week. So they're not concerned that the company isn't going to be able to pay its debt or will cease being a going concern. So that is pretty good. So again, sometimes we end up with a clear winner. I think in this case, we've got two clear winners. I've always maintained throughout the course of our coverage of these two stocks that if you were interested in purchasing a stock in this particular industry, that you do this type of comparison and then select the one that is more desirable at any current point in time because of their reporting schedules and their various the various outlooks that analysts might have. One might be slightly more attractive at a certain point than another, or more reasonably priced. But I think right now both of them are probably in a pretty good place, and I think the outlook, as I said, for 2021 looks really good. Flip a coin, yeah, and it's hard for me to even profess a preference of one over the other. And interestingly, when we started covering LGI Homes, it was very attractively priced because it was being heavily shorted by some traders who thought that they weren't gonna that they were poised to see the price of the stock go down. So the price did go down, but it was a reasonable long-term opportunity at that point. It looked very solid, and so we were able to start covering it when it was very attractively priced, and it's performed pretty well since that point in time. So Al asks, questions. Al asks, what's the range for entry-level homes? Both of these companies are in the $280,000 to $320,000 range. Maybe a slightly lower. It might be, in different quarters and different times of the year, those prices might change a little bit. It might be closer to 265, but I think they've been kind of moving the prices up, and certainly in 2020, prices were moving up because materials were more and more expensive, and there's a lot of demand for houses. So the builders get to charge a little bit of a premium when there's more demand than there is supply, which is where we stand right now. That supports increasing prices. So I think that's we're in the $300,000 ballpark, give or take, $10,000 or $20,000 for the homes that they make. Um, so Mark says, is it possible to do an SSG for a stock not in the data source, entering everything by hand and exporting the ITK file to share with club members? Yeah, absolutely. All you need to do is say file new company, and you end up with a screen that looks just like this. There's the annual data, there's the quarterly data for the last 5 quarters, and you can enter, you certainly need to have high and low prices, earnings, and sales in order to, at the very least, but the rest, the book value, the dividends, if it's available, the net profit, the tax rate, again, you might have to calculate it depending on your data source, calculate the tax rate from the amount of net profit. So it's all achievable. If you get stuck on any formulas, you can kind of look them up. I'm not sure if the Toolkit 6 manual has instructions for entering them by hand, but this is what we did, you young folks, back in the day when there was no internet, when there was no data service. We just had our toolkits and a value line report, and we would type in the values, and I could do it in 6 or 7 minutes. I could fill in all the data at a certain point, because you just get very good about, you know, where it all is, where to find it, how to translate it. So it's certainly possible. Create it. Once you create that file, you can save it and then export it as an ITK file, and that file can be imported in a lot of different places. If it is, it's also possible, if you're a Better Investing member, you can request the stock to be added to the data service. So the way that the data works for the toolkit via StockCentral or Better Investing is that we have a contract currently with Morningstar's, their institutional data division, and they deliver us on a daily basis. Here are all the companies, all the new data for all the companies that we follow for North American exchanges. But they also have OTC companies, and so we don't, because so many of the OTC companies don't fit our criteria, we don't include them by default. But there is the chance that if you inquire, they can look into it and add that company to the data stream, so you would be able to use it in Toolkit, download it. And what's most useful is that when you did a portfolio update, it would bring in the most recent quarters. Now, those stocks tend to get, they're at the bottom of the list to get updated when data comes in, because they're, you know, that's the least followed companies. So you might still be doing some data entry on a quarterly basis when those companies report. But again, pretty straightforward, and that's what I do with a lot of companies that I follow in our SmallCap Informer. We do cover a couple of OTC companies that we've had added to the data service. So you can check that out for sure. You said, should we not include 2020 data to be up to date? Yeah, companies are reporting right now, so that's all coming out. Both these companies, LGI Homes and Century Communities, are only reporting through the third quarter. Both of them will have fourth quarter results in the next couple of weeks. So there are a couple ways. Some people like to enter, and again, this is what we used to do before we plotted the quarters on the graph. When we got to this point, we would use estimated data for the fourth quarter, and sometimes even for the third quarter, to create the estimate for the most recent year, and that would help us kind of give us a sense, because, you know, at this point, the analyst estimates for the fourth quarter of 2020, you've got, or for the full year of 2020, the analyst estimates for the full year, they've got 75% of the data. The first 3 quarters are already reported. So you can go to your source of analyst estimates, find the full year earnings, the full year sales estimates for 2020. It's easy to find the 52-week high and low price as of the end of the fiscal year. And so you can actually, you might not have the profit margin, you know, the pre-tax profit or the book value, but that would give you a sense of the trajectory through in this case through December 2020, and you would that would kind of guide you a little bit further going forward. That is one downside of this method is that here we are in February, and we're still looking at data as of September. 4 months have happened since then. A lot could have happened that we're not seeing on the stock selection guide. So that's a very good thing to keep in mind as you are looking at companies like this. Al says, does one have a better geographical competitive edge over the others in terms of Century Communities versus LGI Homes? I think they're pretty compatible. They have some, they are in some areas, but again, those are the areas where there is high demand for their communities and their homes. So I don't think that one of them is necessarily any better positioned geographically than the other, except that Century Communities is quite a bit larger, so it allows them to have a little bit more geographic diversity, and so I think that might tip it in their favor a little bit. Diane says, how should we evaluate stacks now? Use the Better Investing SSG Plus on their website. Yeah, you can continue to use Toolkit, and with any luck, we'll be talking about Toolkit and still using it in 2022, and perhaps even longer. But if people are coming into your club, don't recommend that they get Toolkit at this point. I would not think that would be a good thing. If you have a Better Investing membership, occasionally I would suggest you getting a little bit familiar with the SSG Plus tool. And the more people ask for features on SSG Plus, asking for the Toolkit features to be implemented in SSG Plus, the faster they will move to that. And so if there are things that you like about Toolkit that aren't in SSG Plus, make the feature request, and the more people that do that, the more that it will, the greater the chance it will be implemented at some point. Terrence says, yeah, the online SSG should have the R squared for sales and sales and earnings, a feature that he uses. So yeah, absolutely. On the SSG Plus tool, there is a feedback forum where you can see the features that other people have requested, and you can vote on them. People can vote on them. You can say, yes, I like this, no, I don't. So make sure you go there, you add that as a feature, and then ask all your friends and club members to vote on it, and that would help ensure it to keep going. All right. Well, I think that wraps it up for our presentation for the first inaugural session of our Tuesday Night Stock Club. I did want to remind you, if you haven't heard, that as of February 1st, Better Investing and iClubcentral moved their headquarters next city over in Michigan, one town further away from downtown Detroit, but to the city of Troy, Michigan. So the address has changed. If you are in a position of mailing a check or a renewal form, for instance, you would want to make sure to use that new address. Mail will be forwarded for the next few months, but I wouldn't trust the mail to be forwarding any mail right now, not even in the next few months. The offices do remain closed for non-essential personnel and visitors, so that's pursuant to state and local guidelines. So don't drop by if you're in the neighborhood, and the move isn't yet complete into the new space. The phone numbers remain the same, and that's what's new for Better Investing. And here is my schedule of mostly online events for 2021. There are some physical events scheduled for later in the year, and again, those are all on hold depending on how we stand in terms of the pandemic. I've got a lot of money show presentations that I will be delivering, a bunch of Better Investing and AAII chapter events that I've just scheduled a couple of them. And later in the year, the Better Investing Convention and the AAII Convention, both scheduled for October, and hopefully those will be able to be held in person. So check the Investor Advisory Service or SmallCap Informer website has the complete schedule there, as well as links to the various websites. If you have questions at any point, please email me at gerlach@iclub.com. Thanks so much for sticking with us. And as always, through 2021, keep calm and stay the course. Get your vaccine as soon as you can. Stay healthy, and we'll look forward to seeing you at our next webinar and hopefully at a live event sometime in 2021. Have a good night.